All right, let's talk about a question that trips up just about every entrepreneur and business student in Canada. When a business makes a profit, who really ends up paying the tax on it? It seems like it should be a simple question, but as you're about to see, the answer is way more interesting.
And just so you know, the material for this explainer was prepared by Samir Al-Rashani, PhD, with AI support.
Here's our game plan. We're going to start with that big fundamental question. Then we'll look at who the tax system actually recognizes as a taxpayer. We'll unpack what flow-through structures are, get into the weird and wonderful world of the corporation, compare two classic business setups, and then wrap it all up with a really elegant concept called integration. Let's do it. Okay, let's jump right in and get to the heart of the matter. So here it is, the big question. A business earns money, the business pays tax. Simple, right? Well, not exactly. In the eyes of the Canada Revenue Agency, it's much more specific. Is it the business name on the sign? Is it the owner? Could it actually be both? Getting this right is honestly the key to understanding how business tax works in this country. So to answer that, we first have to figure out who the tax system even sees as a person who can be taxed. Who are the actual players on the field according to the law? You know, for all the thousands of pages in the Income Tax Act, when it comes to who actually pays income tax, it all boils down to just this one little number, 3. And there you have it. That's the entire list. Individuals, that's you and me, corporations, and trusts. Seriously, that's it. Every single dollar of income tax paid in Canada is paid by one of these 3 types of entities. Everything else is just structure. Now, trusts are fascinating and incredibly useful, but for most day-to-day business operations, they're a bit of a special case. So for our purposes today, we're really going to zero in on the 2 heavy hitters, individuals and corporations. This is where most of the action happens. Okay, I know exactly what you're thinking right now. Hang on a second. What about my friend's partnership? What about my own sole proprietorship? This is probably the #1 point of confusion, so let's clear it up right now. And this concept is absolutely crucial. You have to separate the idea of a business structure from a taxable entity. Some structures are really just conduits. Think of them less like a bucket that holds money and more like a pipe that money just flows through. And here are the most common ones you'll see. Proprietorships, partnerships, joint ventures. These are all perfectly legitimate ways to organize and run a business. But the key thing to remember is that the structure itself doesn't file its own income tax return or write a check to the CRA. So if the structure is just a pipe, where does the profit end up? Well, it flows through to the owners. And who are the owners? They have to be one of our taxable entities, almost always an individual or a corporation. The income, and therefore the tax bill, always follows the money to its final destination. All right, now let's completely switch gears and talk about the corporation, because a corporation is not a pipe. It's a completely different animal. This might sound a little strange, but legally speaking, a corporation is a person. An artificial person, yes, but a person nonetheless. It can own things, it can owe people money, it can enter into contracts all on its own, completely separate from its owners. And this quote is the perfect illustration of what that means. Let's say you're the only shareholder of a company, and that company buys a building. You might feel like it's your building. But legally, no way. It belongs to the corporation. There is a solid legal wall between you and the company's property. And because it's its own legal person, its money is its own money. When the corporation earns $1 of profit, that dollar belongs to the corporation, not to you, the shareholder. And that means the corporation, as one of our 3 taxable entities, is the one on the hook for paying tax on that profit. Okay, so we've got these 2 very different models, right? The flow-through world and the separate corporation world. Let's put them head-to-head in a practical example to really see how this plays out. Okay, on the left, we've got a classic proprietorship, an individual just running their business. Simple. For tax purposes, the person and the business are one and the same. All the profit flows directly onto their personal tax return. But on the right, it's different. We have an individual who owns shares in a corporation, and the corporation runs the business. Now we have 2 potential taxpayers in the game, the corporation and the individual shareholder. Let's put a number to this, say $100,000 in profit. In the proprietorship, that full 100 grand gets reported on the owner's personal tax return in that year. One tax event, period. Over in the corporate world, the corporation itself pays tax first on that 100,000. But look closer, the story isn't over. There's a second point of tax, but it only gets triggered when the owner decides to pull that after-tax cash out of the company, usually as a dividend.
So what's the big takeaway here? It all boils down to two critical things: the timing of when the tax is paid and the total amount of tax that gets paid once the money makes its full journey to the owner. Two very different paths with very different tax implications along the way.
This naturally leads to a big question. If the paths are so different, how is that fair? Doesn't one path offer a huge advantage over the other? Well, this is where the Canadian tax system gets really elegant, with a core concept called integration. Think about it like this. No matter how fancy the structure, where does any business profit ultimately have to end up? In a real person's bank account, right? The entire tax system is designed with this ultimate endpoint in mind. So, that idea of two layers of tax in a corporation, it's really just temporary. The system has a clever mechanism, the dividend tax credit, which basically gives the shareholder credit for the taxes the corporation has already paid. The goal is to make the total tax paid on a dollar roughly the same, whether it was earned directly as a proprietor or earned inside a corporation and then paid out as a dividend. It's called integration, and it's all about fairness. It ensures you choose a business structure for business reasons, not just to play tax games. So we've walked through the whole journey. We've seen that all income eventually finds its way to a taxpayer, an individual or a corporation. We've seen how some structures are just pipes, while a corporation is a taxpayer in its own right. And we've seen how the principle of integration tries to level the playing field. So I'll leave you with this to think about. Now that you understand these different paths, which one makes the most sense for your business and for your own financial future?